Hey guys, Manji here at FX Link. Thank you for joining us on this week's episode of the Traders Podcast. Now, in this week's episode, we are going to talk about Paul Tudor Jones, and I will be accompanied by my co-host, Neil Dube. Now, we are going to talk about his background, about his life, his career, his early career, and what made him a very significant person in the market, in the hedge fund industry. Also known as the second born in his family, in September 28, 1954 in Memphis, Tennessee, United States. As of 2017, he was esteemed as the second highest earning hedge fund managers out there. And as of 2018, he was in the top 20 list of the richest hedge fund managers in the world. Now, some of you might know him for his philanthropic ventures, founding the Red Robin Hood Foundation, which focuses on alleviating poverty throughout the globe, and the Excellent Charter School, which puts boys in college. He also founded the Tudor Investment Corporation, an asset management firm which as of 2017 was having an asset under management of $4.6 billion. Now, as a youngin, he graduated from the Presbyterian Day School, an all-boys elementary school, before he went on to graduate at the Memphis University for high school. Jones went on to study at the University of Virginia, and that's where he acquired his degree in economics in 1976. Now, as we all know, these people were academics. Most of them were academics, and throughout their schooling, we see some of the similar patterns from all of these people. Ray Dalio, George Soros, and Steve Cohen. These people studied economics, or these people studied finance. Either of these two were linking towards the stock market industry.
Okay, well, thank you, Mandla, for that brief introduction. As you all know, my name is No Due, and I'm a co-host, like my partner said, on the Traders Podcast. Well, just to add on what my partner just said, in 1976, Paul worked as a clerk on the trading floor, where he eventually started working as a stockbroker at a firm called E.F. Hutler & Co. in 1918. Finally, he decided that he was going to work on himself, improve himself, where for 2.5 years he decided to work on his own account. He decided that instead of making someone else rich, how about he uses his skills to make himself rich? After that, he applied at Harvard. He got accepted. After a while, he felt like Harvard wasn't really cutting it for him. He felt like Harvard was a waste of time. He realized that Harvard wasn't teaching him any skills that would be applicable into the corporate world. And eventually he quit Harvard, and this is where he started his career that made him who we know today.
Yeah, that's when he started to go out by himself and started to trade by himself, and he actually formed a trading philosophy that really meshed with his style. He traded market turns, and he took a contrarian view of the market. So when the market was going up, he sold. When the market was going down, he bought. So many people, when the market goes down, they like to sell with the trend and go with the trend. So the conventional way is to sell with the trend. He keeps trying the single trade idea until he changes his mind fundamentally. So he has a fundamental approach into the market, and then he takes a technical approach. Once his fundamental approach is changed, then he gets out of the trade. If not, then he sticks with it. Otherwise, he keeps cutting his position size down, and then he trades the smallest amount when he is trading as it's at its worst. Another thing is that when he develops his idea, he pursues it from a very low risk standpoint. So his risk to reward ratios are typical to any other risk to reward ratio of any hedge fund manager. He likes to take low risk trades with high reward output. And he believes that price moves first and fundamentals comes second. He doesn't care about mistakes made 3 seconds ago. Rather, he cares about what he will do after. As you can see, this guy, he took a rather unorthodox approach into the market, and that's what made him recognized into this industry. In fact, his cousin William Donovan introduced him to a guy named Eli Tullis, who owned a trading firm, and he mentored him throughout his trading career, and that's when he started to trade cotton futures.
In 1980, Jones had what Michael E. Gerber calls the entrepreneurial seizure. This is when basically a technician or a worker in a company feels that he can do this better than anyone. In fact, if he can do the technical work in a company, he's good enough to start his own company. And this is what happened to Paul Tudor Jones. In 1980, he started or founded the Tudor Investment Corporation with headquarters in Greenwich. Basically, his firm focuses on trading, investing, research in fixed income, currencies, equities, commodities, and other instruments in the global market. They basically have 4 different trading strategies. Number 1 is a discretionary global macro. Number 2, quantitative global macro. Number 3, discretionary equity, long and short. And the 4th and last strategy they use is called quantitative equity market, neutral, and growth. Well, basically, I won't explain all of them, but I'll give you a short overview on some of them. So for the rest, you can go and Google, as the time for this podcast doesn't allow us to go in depth in all of them. But the first one, like I said, discretionary global macro. In simple terms, before I dig a little bit deeper, this is when traders don't use technical analysis. They trade using the macroeconomics of countries. For example, if I realized that South Africa was going to a recession, as a trade I would sell stocks and most other the currencies of South Africa in assumption that the recession will cause it to have a negative impact on that. But on a deeper level, global macro funds build portfolios around predictions and projections on large-scale events on the countrywide, like I just said, continental and global scale, implementing opportunistic investment strategies to capitalize on macroeconomics and geopolitical trends. Global macro are considered among the least restricted funds, as they generally place any type of trade and they choose using almost any type of security. Now, there are 2 types, but in this case, like I said, we're going to focus on discretionary global macro. This construct portfolios at the asset class level based on a top level view on the global market. This type of global macro fund is considered the most flexible, as managers can go long or short with any type of asset anywhere in the world. And the second one, if you can remember, was quantitative global macro. Basically, this is the same thing as the first global macro. In this case, quantitative just means you use mathematics in order to figure something out. So in this case, if we were to look at the macroeconomics of a country, this way we would focus on the inflation, the GDP, and all the other things, all the numbers. Instead of just looking at a political view, would focus on the numbers and the math behind what's happening in the country. The third type is discretionary equity, long and short, and the 4th was the quantitative. But the discretionary, in simple terms, discretionary trade means that you trade based on a current market condition. You don't have a systematized way of trading. You trade based on what you see and what the market does at this point of time.
Now, one of the earliest and major successes was for Tudor Jones Investment Corporation was predicting the Black Monday in 1987. It is said that he tripled his money during the event due to large short positions. So what he did is that he continued to put short positions once the market was in a position that he had anticipated. Now, Peter Borish was second in command at Tudor Jones Investment Corporation, and Jones said that Borish anticipated the crash in 1987 because Borish mapped out the 1987 market against the market preceding the 1929 crash and noted the similarity between the two markets. Now, this guy, he studies the market for a living, and he saw that the patterns that happened in 1929 crash actually was happening in 1987 in their time. And in finance, Black Monday refers to Monday, October 19, 1987, when the stock market around the world crashed. The crash began in Hong Kong and spread west to Europe, hitting the United States after other markets that had already sustained significant declines. The Dow Jones Industrial Average fell 508 points to 1,738, which is a 22.61%, and that was the largest one-day crash. By the end of October, stock markets had fallen in Hong Kong 45%, in Australia 41%, Spain 31%, the United Kingdom 26%, the United States 22%, and Canada 22.5%. Now, Black Monday decline was and currently remains the largest one-day percentage decline in the Dow Jones Industrial Average.
Yeah. So just to sum it up, currently, or the latest thing to highlight on Jones' career is that previously Jones served as a director of the Futures Industries Association. This was kind of for him giving back to the community. Well, he was involved in creation and development of an educational arm for the association. Secondly, also as an advocate for the design and implementation of the first ethics training course that became standard for exchange membership on all futures in the USA. Well, thank you for staying up to the end of our podcast. I know this was relatively short than all our other podcasts. And currently, we like to apologize for the changes that have occurred on our channel, as we won't be releasing our podcast on a fortnight, meaning every 2 weeks, but rather on a monthly basis. So we'd really like to apologize for that. But besides that, we really hope you enjoyed this podcast. Just below, there's a word written in red. Make sure you click that, so whenever we post something new, you'll be notified. And hit the thumbs up on this podcast so we know that you like it, and we can continue producing more videos like this. With that being said, for me and my partner Mandla Msibi, enjoy, peace.